Let's be honest, the era of made in China is ending. For decades, it was the unquestioned engine of the global economy, but that engine is starting to sputter. So today, we're diving deep into its replacement, made 10 miles away. This is the new investment goldmine, and it's being driven by robotics, AI, and just a totally radical rethinking of how we make things.
So here's the game plan. We're going to start with the great unwinding, why the old system is breaking down. Then we'll get into the cool tech with the factory in a box. After that, we'll talk strategy, how you can actually invest in this local production shift. We'll also face the hard realities, what I'm calling the brutal truth of atoms. And finally, we'll look at the sheer scale of this change and what it all means for the new economy.
All right, so first things first, why is all of this happening right now? Well, for the better part of half a century, we built this incredible system of global manufacturing. It was a marvel of efficiency, but as we've all learned the hard way, it was also incredibly fragile. And those cracks are now just way too big to ignore.
You know, this quote right here really nails the core logic of the last 50 years. The strategy was dead simple. Go find the cheapest possible labor, which, for a very long time, meant outsourcing everything to places like China. But as the source material points out, this created a really weird, kind of perverse incentive not to invest in your own business back home. Think about it. Why would you spend millions on a fancy robot when you could just hire thousands of people for pennies on the dollar? That short-term thinking, that chase for cost savings, has now created this massive long-term vulnerability, and now the entire global economy is scrambling to fix it.
This whole obsession with low-cost labor gave us what's called just-in-time manufacturing. And honestly, it was a work of art, a perfectly choreographed global dance where parts would show up at a factory maybe just hours before they were needed. The problem? A single ship gets stuck in a canal or a global pandemic hits, and the entire system just grinds to a halt. So the new paradigm, the new mindset is shifting to just-in-case manufacturing. It's all about prioritizing resilience over that pure, brittle efficiency. The goal isn't just to be cheap anymore, the goal is to be certain.
Okay, so if the old model of these gigantic, centralized factories is breaking, what's going to replace it? This is where the technology gets really, really cool. We're talking about a complete flip of industrial logic, and it's all made possible by some seriously revolutionary tech coming together at the perfect time.
And the answer is the microfactory. Seriously, forget what you think a factory looks like. Those sprawling industrial parks the size of a small city. A microfactory can fit inside a standard warehouse, maybe just a few miles outside of a major city. It's flexible, it's decentralized, and here's the kicker. Instead of relying on thousands of workers, it relies on advanced automation to build stuff right near you, the end consumer.
Now, this isn't just about a slightly better robot on an assembly line. No way. This is a massive leap forward, and it's fueled by three key technologies that are all hitting their stride at once. First, you have agentic AI. Think of this as the factory's brain, the manager, not just the worker. It's software that can plan and execute complex tasks on its own to reach a goal. Second, you've got physical AI, which is all about putting that brain into a body. And third, advanced automation, which is like the nervous system that connects everything and orchestrates the whole show.
And this image is the perfect example of what physical AI actually looks like. It's not some abstract algorithm floating around in the cloud. It is real hardware, like Tesla's Optimus robot, that can see, understand, and manipulate things in the real world. These are literally the workers of the microfactory, and the amazing part is they can be reprogrammed to do totally new tasks on the fly. That gives them a level of flexibility that old-school assembly lines could only dream of.
So, the big question, how does all this exciting tech stuff translate into a real investment thesis? I mean, it's one thing to understand a trend, but how do you actually get some financial exposure to this revolution? Well, the answer might not be what you think. It's not necessarily about betting on the company making the final shiny product.
The key here, the really crucial point, is to use the classic picks and shovels strategy. You've probably heard this before. During the big gold rushes, the folks who made the most consistent money weren't the ones digging for gold. Nope, it was the people selling them the picks, the shovels, and the blue jeans. In this new industrial revolution, the exact same logic applies. You want to invest in the foundational tech, the infrastructure, that every single one of these microfactories is going to depend on.
And that means looking at a few critical layers. First up, thermal management, which is just a fancy way of saying cooling systems. All these high-powered robots and servers run hot, 24/7, and someone's got to keep them cool. Then you've got the networking companies, the ones building the super-fast digital highways for all the data to travel between the AI brains and the robot bodies. You also have the nuts and bolts infrastructure companies that provide the raw power and actually build the facilities. And finally, here's a really interesting angle our sources point out: the rise of private equity platforms. These let investors like you get in on the ground floor, funding these startups directly before they ever hit the public markets.
But hang on, before you go all in on this, we need to have a serious reality check. See, for the last 20 years, investors have been obsessed with asset-light software businesses, the ones that can scale to millions of users with almost zero cost. This is not that. As one pro source puts it, this is a business of atoms, not just bits. And investing in the physical world comes with some brutal, unavoidable truths. One of our sources gives this perfect, simple analogy to help understand a key risk here. Think of a factory machine like a lemon squeezer. The second you buy that expensive piece of hardware, it starts losing value. It gets used, it wears out, it gets older, and eventually a newer, better model comes along. That process is called depreciation, and it's a constant downward pressure on the value of your physical stuff.
This brings us to the central challenge, a term that investors in the world of atoms live and die by: capital expenditure, or CapEx. These advanced robotic systems are incredibly expensive. We're talking millions of dollars for a single production line. Unlike a software company that can just add another user for pennies, this is a capital-intensive game. It requires a huge pile of cash up front just to get in the door.
And here it is. This is the biggest risk of all. What happens if you build a fancy microfactory to make, say, a specific type of phone case, and then a year later, nobody wants that phone case anymore? Well, that multi-million-dollar, highly specialized machine becomes a worthless boat anchor chained to your balance sheet. It's what's called a stranded asset. You can't easily sell it or repurpose it, and it represents a massive potential loss.
On top of all those physical risks, the market valuations are just wild. This whole AI-driven revolution is surrounded by so much hype that you have to be really careful. Our sources point to a company like Palantir, which at one point was trading at over 100 times its annual sales. To put that into perspective for you, it means investors are so optimistic they're basically pricing in decades of flawless, massive growth from day one. Any little hiccup, any sign of trouble, and those stocks could absolutely plummet.
Okay, so we've established the risks are very real. But despite all that, the sheer scale of the capital and the momentum pouring into this transition is truly staggering. Let's just look at some of the hard numbers projected for the 2026 horizon, just so you can get a sense of how big this wave really is.
First, let's just talk about the fuel for this whole revolution, the money being spent on AI itself. By 2026, total worldwide investment is projected to hit an eye-watering $2.5 trillion. This is not a niche trend, people. This is a fundamental replatforming of the entire global economy.
And where's a huge slice of that money going? Right into the physical hardware. Spending on servers and data centers, which are basically the digital concrete for this new industrial age, is expected to surge by almost 37%. This is the foundation that all that AI is going to run on.
But all that new digital concrete creates a huge problem. It is incredibly power-hungry. The projected energy demand just from AI data centers is set to hit 156 gigawatts. That's more power than many entire countries use. It's creating a massive energy bottleneck, which, of course, is also a massive investment opportunity in energy infrastructure.
So, we've seen the old system breaking down, the rise of the new technology. We've looked at the investment angles, the risks, and the unbelievable scale of this transition. So what does it all mean? How should we really wrap our heads around this fundamental shift in economic logic? And this brings us to the final, and maybe the most crucial question of all. For 50 years, the entire game was about one thing: how to cut costs. We chased efficiency to the ends of the earth. But if that's not the main goal anymore, where is the real value being created in this new economy?
And the answer is a massive pivot from efficiency to resilience. The new premium isn't on being cheap, it's on being certain. The value is created by building a supply chain that doesn't completely fall apart during the next global crisis. It's the ability to withstand shocks and guarantee that products are still on the shelves no matter what. And companies are now absolutely willing to pay for that stability.
So if there's one thing to take away from all this, it's this: the entire economic calculation has fundamentally changed. The driving question of the 20th century was, how cheaply can we make this thing by finding the lowest cost of labor? The driving question of this century is rapidly becoming, what is the true cost of failure if our supply chain breaks? And as we've all learned the hard way, that cost is far, far higher than anyone ever imagined.